So we are going to start with a new chapter today, which is on bank reconciliation. So as you know, last week we did the prime entry books, or the books of prime entry, where we record transactions. So I think we had two questions to be completed there. That is the cash book and the petty cash book. So we will come to that once we do this. So when we did the cash book, I explained that it is a double column cash book, and the purpose behind the double column cash book is to record the cash transactions as well as the bank transactions. So can you all hear me?
Yes, sir.
Right. Okay. So you all can see the screen also, no? Is the screen visible? Okay. So we are going to start with the bank reconciliation. So what is expected out of bank reconciliation? Bank reconciliation is a process performed by a company to ensure that the company's records are correct with the bank's records. So now you know that when you are operating a company, companies would prefer to have a bank account because a lot of their customers might not be interested in doing cash transactions. So when you look at why banks are existing, is one of the purpose of this. That is to facilitate the transactions of your customers, who are in turn customers of each other. So they would like to route their transactions not in cash form but through banks. So as a result, the bank accounts, or the company maintaining a bank account, becomes very, very important for the business. But then again, the company may have to maintain the bank account records internally also. That is, you already know that the bank will generate all the information pertaining to the bank account. That is, you can give them a balance inquiry, you can give them a statement, bank statement. So you will provide various kinds of information to the customer. But from the customer's point of view, customers should have their own records. Now, what do I mean here by company's records is that is specifically the cash book that we learned last week. So you know the cash book had two columns. One is the cash column itself, and there was another column which relates to the bank. So whenever you originate a transaction relating to the bank, you will record that in the bank column. That is what we learned last week under books of prime entry. And in cash book, we learned that all transactions pertaining to the bank are recorded in the bank column. Similarly, all transactions happening through the bank also will be recorded by the bank in the name of the company. So now here we have two sets of record pertaining to the same. That is, you are having a bank account for which you are maintaining a record in the cash book, and the bank is also maintaining a record of your account, as it is a responsibility of the bank towards its customer. Now there are two records. Now these two records, ideally speaking, should match. That is, your cash book bank column and whatever the record that is provided by the bank as the bank statement should agree with one another. But in most cases, this may not happen. If you are a company having a lot of bank transactions, generally this won't happen. So when there is a difference between the two sources of transactions, or in other words, the two sets of records of transactions, then there comes a reconciliation requirement. That is, you need to reconcile the cash book bank column and the bank statement to find out why there is a difference. And this difference have to be produced in the form of a statement. Again, that is what we call as bank reconciliation statement. Bank reconciliation statement. So the bank reconciliation statement is basically prepared to understand and identify the mismatches between your cash book records and the bank records. If the two sources are independent of each other, then this provides some confidence that the data is accurate. So it is the same thing that I referred above. You have one set of record which is coming from your own cash book, and the other set of record is from a totally independent party, which is the bank. So there is no influence between the two parties. If that is the case, the information that you are going to get out of from these two independent sources are considered to be much more accurate, because it is not the same person doing both side of transactions. I mean, it's not the transactions as such, it is the recording of the transaction. But in the case of the real world, the amount stated in a bank statement, as I told you, as a customer's bank balance on a particular date is unlikely to be the same as the balance in that customer's cash book. So it's very rare. That is what it says. In most of the cases, the bank statement balance as what you show in the bank statement of a particular customer's bank account and whatever the balance that is reflected in the customer's cash book is generally different from one another. If most of the cases, if these two are to be agreeing, which means there has to be a reasonable time gap and there could have been no transactions also. So the bank reconciliation statement is prepared to discover the reasons for mismatches between the balance confirmed in a bank statement and the bank balance stated in the cash book. So this goes as the definition for a bank reconciliation statement. So in exam, sometimes you might be required to write what is the bank reconciliation statement. If that kind of a question comes, this is the answer that you have to provide. A bank reconciliation statement is prepared to discover the reasons for mismatches between the balance confirmed in a bank statement and the bank balance stated in the cash book. Now let us look at some reasons for the differences. So we are talking about two independent sources. One is being the bank statement and the other being the customer's cash book. So now we are trying to agree these two, whereas it is not agreeing, and you find certain reasons for the differences. So now let's look at one by one. What are these reasons are? What are these reasons are? Number one, this is one common difference that you may find. That is, checks deposited but yet to be realized. Checks deposited but yet to be realized. So I'll have this and the second one also. Checks issued but yet to be presented to the bank for payment. Checks deposited but not yet to be realized, and checks issued but yet to be presented to the bank for payment. So let me make use of the board for this purpose. So now we are talking about two kinds of information, which is one is considered to be the checks deposited not yet realized. Okay, and the other one is checks issued but not yet presented. So these are two important transactions which you might see as the reasons for the difference between the bank statement balance and the cash book balance. Now let us try to understand this. Checks deposited, not yet realized. So what does it mean? If you are a company, let's say you are company A, and you are selling goods. So you have sold goods to a customer of yours called Mr. B. And this transaction is on credit terms. Because if it is a cash transaction, you would have immediately received cash and you would have delivered the goods, which I have already explained in previous classes. Now, in this particular transaction, where there is credit given, let's assume that it is 45 days. So within this 45 days, now this customer B has to settle customer A. So when that happens, let's say on the 43rd day, customer B comes and hand over a check, and there is a number, let's say 735456, just a number. And the amount is, let's say, rupees 35,000. Now, when you receive this check, immediately what do you do? As we learned last week, you will go and debit your cash column of your cash book until it is deposited in the bank. Okay? You will debit your cash column with this check until you have taken this check and deposited in the bank. So, once the check is received, you will debit your cash column for this 35,000 and you will say Mr. B, and the check number is 735456. Assuming that you deposit all your checks on the following day. Now you have gone and deposited the check into the bank. Now this is happening on the very next day. So you receive the check. Let's say today is 12th. Let's assume you are receiving the check on the 13th of, that is tomorrow, 13th of July, and you are depositing it to the bank on 14th of July. Right? Now on 14th of July, you are going and depositing this check into the bank. So what you do in your cash book, now you will credit 35,000 in your cash book, cash column, and now you are going and debiting your bank column in your cash book with 35,000. Which means now you have gone and deposited the check in the bank. So as soon as you deposit it in the bank, you will credit your cash column with 35,000 and debit your bank column for 35,000. Now what is the assumption? I assume that I have gone and put 35,000 rupees in my bank account. Something similar to that. But the question here is, you have not given cash to the bank. What you have given is a check. And this check is given by Mr. B. So what will happen when this check is presented to your bank account or accepted by the bank? This check will go for clearing. We call it as clearing. That is, you have to process the check. You have to process the check. Now suppose if A and B, both of them are having their respective bank accounts in one particular bank, right? Let's say both of them are having their bank accounts in PQR bank. PQR bank. So what does it mean? A also goes and deposits their check into the PQR bank, and B also issues a check of his account with PQR bank. So when this check is presented, if B, Mr. B, has money in his bank account, immediately his bank account balance will come down and company A's bank account balance will go up by this amount. Okay, that is very straightforward. Where both parties having their bank account in the same bank. So immediately if the customer B has balance, bank balance, adequate balance, that is say if he has 35,000 or more, immediately company A will get the benefit of rupees 35,000. So then there is no problem. Immediately you will have the money. Suppose, let's assume B doesn't have the account in PQR. Their bank account is with, let's say, LMN Bank. LMN Bank. Sorry, I don't know whether you all can see the board. Let's assume it is LMN. Now what is going to happen? This check comes and gets processed in PQR bank, and it will go through the process of clearing. It will go through the process of clearing. So you know that what is the clearing house name given in Sri Lanka? Can somebody tell me what is the clearing house, name of the clearing house? Does anyone know? Very good. Lanka Clear. So Lanka Clear is the clearing house in Sri Lanka where these checks will process at Lanka Clear. So generally, if this is a check presented in Element Bank, for PQR Bank to receive money, it might take 1+. We call it as 1+ days. Okay, 1+ days will take. Sometimes it might be two days. So let's assume this check gets processed and A will get the money on 16th. Just an assumption. So A is going to get this 35,000 to his bank account only on the 16th. Only on the 16th. Right? Now comes the problem. We take a cutoff on the 15th. We take a cutoff on the 15th. Let's assume. Now on the 15th, if I ask you, what is the bank balance, or what could be the bank balance of, assuming that it was 0 previously, what could be the bank balance of company A as per company A's cash book? Company A's cash book. Obviously, you will say it will be 35,000, because when you deposited this check on the 14th, you have immediately debited your bank column of your cash book. So your balance of the bank goes up by 35,000. If you didn't have any balance, it will be 35,000. But if you had a balance, then it will go up by 35,000. But as far as the bank is concerned, on 15th of July, there is no money, because the money is given only on the 16th. Money is given only on the 16th. So it is very clear that if you look at the two sources, that is your company's cash book and the bank record, this check will appear only in your cash book. It will be not there in the bank statement or the bank records. Why? The money is coming only on the 16th. Very important. So now what are we trying to say? We call this in banking terminologies. You have deposited a check, that is checks deposited, but this check has not yet realized. It is getting realized only on the 16th. So your realization date is only on the 16th. But if you take on the 15th, this balance has not realized. So you observe that there is a mismatch between the two records, that is the bank books, that is the bank statement, and the cash book that you are having, which will have a difference of 35,000 compared with one each other. Okay. So what do we mean by checks deposited not yet realized? Means you might have received a check. Sometimes you might have not sent it to the bank. But sometimes, even when you send it to the bank, the check gets realized only subsequently. As I told you, if it is pertaining to some other bank, then the realization of the check might happen very late. So in between, if you take a cutoff, this check will not appear in your bank statement, whereas it will appear in your cash book. So this will create a difference between the two records, and that becomes a reason for the reconciliation. So as far as the reconciliation is concerned, you have a difference of 35,000 between the two records. That is company A's cash book and the bank statement. But this is again as of this particular date. So what does it mean to us? The bank reconciliations are done as at a particular date. As at a particular date. You can't be doing it for a period. We don't do it for a period. Bank reconciliations are always done for a particular date. So in this case, we are doing the reconciliation as of or as at 15th of July. So if we are doing it for 15th of July, then obviously you know the cash book of company A will have this 35,000, but the bank statement or the bank balance on 15th of July will not have this 35,000. And that becomes a reason for the difference. A reason for the difference. So I'll give you 1 minute or 2 minutes. Just quickly take down this for your reference. Okay. So I hope it was clear how this difference between the bank record and the company record is going to cause a difference with checks deposited not yet realized. So checks deposited not yet realized means the cash book record will have the check deposited as a balance, but whereas in the bank statement it won't appear until the funds are getting cleared. So we call this in banking terms as unrealized funds. Unrealized funds. So if you take this company A's unrealized funds as at 15th of July, that is 35,000. But on 16th of July, the customer will be able to withdraw this 35,000. This is simple as your bank account. Sometimes when you go to the ATM and withdraw money, even though you know that there is a higher balance, sometimes you may not be allowed to withdraw the entire amount. So what do you mean by that? As of this date, the available balance is 0 for the bank. But then comes on 16th of July, you will have this 35,000. So that means the realized funds and the unrealized funds. Now let's go to the next reason, which is known as checks issued but not yet presented. Not yet presented. So let's take an example. C and D. So let's assume this is the company that we are talking about, and this is a supplier. This is a supplier. So who has provided stationery? Stationery. So you have provided stationery. This supplier has provided stationery with a credit term of 30 days. Credit term of 30 days. Okay. Right. So let's assume on the 28th day, or let's make it very simple. This transaction happens on the 1st of July. Transaction happens on the 1st of July. So which means the settlement has to take place on 30th or 31st July. On 31st July. So on the 28th of July, company C gives a check. Okay, 634549. Let's say the check number is 634549, and you are settling the amount of 125,000. So you have given a check. Company C is you, assuming that company C is you. So to the supplier, you have given a check on 28th of July. This is the number and this is the amount. So as soon as you give the check to the customer, that is your supplier, what will you do? What would be the double entry? The money is going to go out of the company. Money is going to go out of the company because you are giving a check means instead of giving cash 125,000, you have given a check now. So what does it mean? I don't have cash at this moment. As a result, I am giving them a check of this much. So once the check is given, what will you do? You will go and credit your bank column instead of crediting the cash column, because this is not a cash transaction. This is a bank transaction. Whenever there is an involvement of a check means that is a bank transaction. So you are now going to go and credit your bank column. Your bank column in the cash book. So you will credit your bank column in the cash book. CB means cash book. Okay. So automatically your bank balance in your cash book will come down by 125,000. 125,000. Okay. Now just think about this. This is happening on the 28th of July. Once this supplier got this check, the very next day he is going abroad. He is going abroad. So this check that was given by you, company C, is in the supplier D's, let's say, drawer. He has put to the drawer and he has kept it there and he has gone abroad. And he is returning only on, let's say, 10th of August. 10th of August. 10th of August. Right? So now, transaction has happened on 1st of July. You were given 30 days credit and you are given a check on the 28th of July. But the supplier has not put the check into his bank account and he has gone on abroad and he is returning only on the 10th. Now, let's look at the cutoff point of 31st of July. 31st of July. When you take 31st of July, again, let's assume company C's bank account is PQR for simplicity. So company sees cash book bank column. If you take this 125,000 will appear as a credit, which means your bank balance will have come down by 125,000. Bank balance would have come down by 125,000 because you have given the check. You have given the check on the 28th because you will record this transaction on the 28th. But now we are looking at 31st of July. Now, as of 31st July, yes, you have reduced your bank balance by 125,000 in your bank books. But unfortunately, this particular check 634,549 has not reached your bank account even on the 31st of July. Why? This person has kept the check and gone abroad. So he is going to come back and put the check only on 10th of August or maybe after that. 10th of August or maybe after that. So until such time, this check will not reach your bank for payment. This check will not reach your bank for any payment. So now comes the problem. If this check has not reached your bank means until it reaches your bank balance will be higher by 125,000 because this has not got deducted. This amount of check has not come to the bank even on 31st July. So if I take a bank statement on 31st of July, this check won't appear. This check won't appear as a debit. You see? So your cash book, as far as your cash book is concerned, you have already paid this. You have credited. But in the bank records, this check has not yet come. So why it has not come? Because this person has not presented it. This person has not presented it. He can only present after 10th of August or maybe on the 10th of August because he has left the check and he has gone abroad. So this scenario is known as checks issued but not yet presented. Not yet presented. We call this as unpresented checks. This is unrealized checks. The two classic scenarios. Unrealized checks, unpresented checks. Unpresented checks. So here, why your bank balance in the bank statement was the cash book bank balance was more because you have considered it to be already deposited. But in the case of the bank, it was not realized. Here, you assume that you have already paid this check and the money has gone out. But as far as the bank is concerned, this check has not yet come. So these are the two classic scenarios when it comes to the bank reconciliation. This you have to understand very clear. Checks deposited not yet realized and checks issued but not yet presented. So I would like you to take down that also before we move into the next reasons. Okay. So let's go back to the presentation. So as I told you, the two main reasons checks deposited but yet to be realized, that is one side of a transaction which has an impact on the bank reconciliation, and the second being checks issued but yet to be presented to the bank for payment. So that is unpresented or checks not presented for payment. The third one is slightly different. Now, you know, when you are managing a bank account or maintaining a bank account, the bank has a responsibility to maintain this account using certain conditions. So what does the bank do? For the purpose of maintaining this account, the bank charges a bank service charge. So that normally happens. When you are maintaining a bank account, you must be knowing that the bank will charge you with a service charge as minimum amount. Similarly, in some of the cases, when the bank decides to pay you an interest for the balance that you maintain with the bank, what happens? You might credit that interest to the bank account. Then you might also observe that when you obtain a checkbook from the bank, it has a particular cost. Checkbook has a cost. So the bank will charge you the checkbook cost from your bank account directly. From your bank account directly. Now, these are some of the transactions that I have been quoting as examples. But you know, all these transactions happen in the bank directly as a debit or a credit to your bank account. So as far as the customer is concerned, customer might know some of the transactions, but many of the transactions they might not know, because the bank service charge, how much is charged or when it is going to be charged, the customer doesn't know. The interest, you don't know how much of interest that you will get or how it is calculated or when it is going to be credited. Now, normally banks, if it is a savings account, you will credit it on the last working day. That is what the normal practice is. But that is not a hard and fast rule as far as the banks are concerned, because you can deposit the interest at any date that you want. So it is the decision of the bank to credit the interest. Then checkbook charges. Of course, the customer might know what is the cost of a checkbook. But the problem is when it is going to be charged, the customer might not know. So these are some of the transactions which happen directly in your bank account, which the customer may or may not know. So we call these transactions as direct bank transactions. Please take down. These transactions are known as direct bank transactions. So what happens here? Either the customer's account will be debited directly by the bank, which is called a direct debit, or sometimes, like in the case of interest, the bank might credit your account. Credit your account means your balance will go up. So that is known as a direct credit. Okay. So there are direct debits as well as direct credits. Now, how will this cause a difference? Obviously, it is very clear that any transaction that is happening directly in your bank account will not be known to the customer until the customer receives the bank statement. Okay, because you might know the transaction, but you don't know the amount. Sometimes you might know the transaction, but you don't know when it happened. So it all depends. When you receive the bank statement only, you know what has happened on which date and how I should record it in my cash book. So the direct debits and credits, you will need to understand that will not be recorded in the bank company books until the bank statement is received. Until the bank statement is received. Because as you know, for every transaction, there has to be a source document. So the source document for these type of transaction is this bank statement. Now, when you receive the checkbook, they will not give you an invoice, don't you? So you know that when the bank issues a checkbook, there is no invoice given or a bill given. So you will know the amount of the cost of the checkbook only when you receive the bank statement. So the direct transactions or the direct bank transactions will be known to you only when you receive the bank statement. And this is going to cause a difference. Why? You will have not recorded these transactions in your books, whereas the bank has recorded all these transactions. Then there is a mismatch between the two sources. Then there could be a situation where some of your customers might have gone and deposited money directly to your bank account, which is possible. Say, for example, you are a company operating in Colombo and you are supplying stationery, say, island-wide. So there is a customer who comes and buys stationery from you in Colombo and he is located in, let's say, Jaffna. So he is somebody who is supplying stationery to the Jaffna region, but he is coming to Colombo and purchasing it from you. Okay. So once this purchase is done, you might tell the customer, look, you don't need to come to Colombo to pay me. You go and deposit it to my bank account. Those options are available. Now, even to your friends or to your relatives, parents, you will do that. Sometimes when you are supposed to receive money, you might tell them, look, you don't need to come and meet me. You go to the closest, nearest branch and deposit it to my account. This is my account number. And these type of transactions can happen at any time, which you don't know, unless the depositor sends you the copy of the deposit slip or an image of the deposit slip. You don't know. So when those type of direct deposits happens to a company's bank account, which are directly deposited by the customers, those transactions will be recorded only when the bank statement is received or you receive the deposit slip. This is again going to cause a difference. Why? As long as you don't know about these deposits, you will see it only when the bank statement comes. So as a result, now your bank account balance of your cash book and your bank statement balance will not match with each other. Will not match with each other. Then this is another difference. Amounts collected by the bank through standing order instructions from other parties. Very straightforward. Sometimes what happens, we give to the bank certain instructions and we call these as standing orders. Standing orders. Suppose we say that you want to pay your insurance premium. That is for your vehicle. You are supposed to pay your insurance premium every year. So let's say sometimes you might forget this payment of insurance premium. What happens? You can ask the bank on your behalf to make a payment every year on such a date. You can specify a particular date, and on that date, you can say the bank to pay this insurance premium. Now, this transaction is actually instructed by you. You have given instructions to the bank. But what happens? Sometimes the bank may have done it or may have not done it. So as far as you are concerned, once you see it in the bank statement that this particular transaction has happened only, you can go and record it in your cash book. Until you see this transaction as a standing order or bank transfer or whatever you may call it, you can't record it in your cash book. So your cash book requires a source document to record a transaction. And again, in this case, it is the bank statement that is going to facilitate this particular transaction. The next item, checks that have been dishonored by the bank. Checks that have been dishonored by the bank. We call this as check returns. Check returns. Now, initially we saw that there is a check deposited, not yet realized. Now it is something similar to that. You have deposited a check, but subsequently it has got returned. It has got returned. So, but when the check gets returned, you are not notified. It might take some time. So as a result, what happens here? You have to record this transaction when you get the check return notification or the bank statement. Until such time, you are not allowed to record this transaction in your cash book. And finally, this is a case where very rarely it could happen, but in the case of customer's cash book, there could have been errors because it is mostly a human who is going to enter these transactions. So there could have been errors in the customer's cash book. And very rarely you will have errors in the bank's accounting systems also. So the last two items, that is errors in the customer's cash book and errors in the bank accounting systems, is something which is not commonly seen. So you may call it as rare items, but in your exam questions, these can be given as reasons. So you should know if there is an error in the customer's cash book, you have to rectify it. Similarly, if they say there is a bank error, then you should know how to deal with that when you are doing the bank reconciliation statement. I hope up to that point you are clear. So if you have any questions, please raise. If you have any questions, you can ask now. Okay, no questions. Yes, receiving SMS alerts. Now we are talking about the new technology. So as long as the company policy permits that the SMS alert as a valid documentary evidence, you can make use of that as a documentary evidence and update your records. Okay, so it's a company policy where the company has to decide, okay, we are going to make use of any digital confirmation from the bank as a valid documentary evidence. So if it is considered as a valid documentary evidence, the company can proceed with recording the transaction. Okay. And there was another question. Interest should not be considered since it is a current account, isn't it, sir? Yes, I told you. So current accounts, yes, we don't pay interest. But there are instances where people maintain money market accounts. You know what is the money market account is? So money market accounts, you pay interest. And there can be instances where sometimes you might take the interest that you would have earned from your fixed deposits, savings accounts into your current account. It can come in the form of a transfer. The interest that you have earned from the fixed deposit, you might have instructed the bank to transfer it to your current account. So that is also possible. So interest need not be purely on your current account. It should be something that is earned from another account, which could have come into this account that you are using as your bank account. Okay. Right. Are there any other questions? Okay. So now we are going to look at some key points. The reconciliation is always as at a specific date. Very important. I told you in the example that we saw earlier, it was 15th of July or maybe 31st of July. So we know that the reconciliation is done as at a particular date, one particular date that you consider to do the reconciliation. Okay, so it is very important to know that reconciliations are done as at a particular date. The date does not necessarily have to be the last day of the accounting period or even the last date of a calendar month. Again, remember, the date of the reconciliation, not necessarily the last day of the month or the last day of your financial year. Now, I know that you all are now familiar with what is a financial year is. So if you take the financial year ending 31st December, it need not be a reconciliation where you do it on the 31st of December. Bank reconciliations can be done at any date that you want. But what happens in organizations or companies, they make it a practice to do a reconciliation at the last day of the month or the last working day of the financial year, because those will be required by the auditors. Okay, so when the auditor carries out your audit, they would like to know the bank reconciliation as at that particular financial year end period or maybe the month end date. Okay, but it is not a hard and fast rule where you will have to do a reconciliation as at the last day of the month or last day of the accounting period. The reconciliation could well be the balance as at a particular date as reported in the cash book and as at the same date as stated in the bank statement. Now comes the problem. Now you know the bank statements are not produced very frequently unless you go and make a special request to the bank. So bank statements are generally generated covering a 1 month period or maybe a quarter period or maybe for an annual period. So it is very clear that the bank statements will be produced as of a particular date. So what companies will do is they will do the reconciliation also pertaining to the same date. Without complicating the reconciliations, you take the most appropriate date which is given in the statement as against what is appearing in the cash book. So obviously, the bank reconciliation dates are determined based on the bank statement date and the company's cash book record. So that is what it is given here. The reconciliation could well be the balance as at a particular date as reported in the cash book and as at the same date as stated in the bank statement. So the reconciliation now involves two aspects. Each item in the bank statement needs to be traced to the bank account. Each item in the bank account should be traced to the bank statement. Now let's look at this on the board. Now what are we talking about here? You are talking about two sets of records. Okay. This is your cash book and this is your bank statement. Okay. Now in your cash book, you have debits and you have credits. Similarly, in your bank statement also, you have debits and you have credits. And finally, you will have a balance also in the bank. And here also, let's say you have a balance. Okay. Now, please follow this because it's very important. Now, this is your cash book balance. Okay. And this is your bank statement balance. Now, cash, we are not talking about physical cash here. You talk about the bank account, bank balance only. We are talking about the bank balance, which is appearing in the, let's say, cash book bank column. Let me put it very clear. Cash book bank column. So your cash book bank column is generally an asset. Generally an asset. So what kind of a balance it is? This is going to be a debit balance. You know that. If it is an asset to you, your balance is going to be finally a debit balance. And this bank column is the one that is reflected in the bank statement as your bank account balance. Now the balance in your bank account is what for the bank? Is it an asset or a liability? Now say you have lots of accounts, thousands of accounts of your customers. All those are, I'm talking about from the bank's point of view. Are those accounts assets or liabilities to the bank? What do you think? All those are liabilities to the bank. I think some of you are responding. Very good. So all these are liabilities to the bank. Okay. All these are liabilities to the bank. So When it is liability, what is the balance that you may see in the bank books? It's a credit. Very good. It's a credit balance. Now this is very fundamental and very important one that you need to understand. Now you are trying to match two records. One is your cash book, one is your bank statement. So generally your cash book is expected to have a debit balance and your bank statement to show a credit balance. Why? Bank statement is given from the point of view of the bank. Cash book record is prepared from the point of view of my record, that is the company's record. Okay? So you can't match these two with the same balance. It may not be the case. May or may not be. As we go on, you will learn that. But generally speaking, since this is an asset, I will have a debit. Since this is a liability for the bank to pay me, that is the company, they will show it as a credit. So the matching will happen, the debit against the credit against the debit. You see, this debit will go against this credit, this debit will go against this credit. Now the 2 points that I have given last in the slides is that marking of the items in the respective records. Marking of the items in the respective records. Let me give it in the same way that is here in the. They say each item in the bank statement needs to be traced to the bank account. Each item in the bank account should be traced to the bank statement. So what is it that we are trying to do here? You take these debit column items, this one, this one, this one, and go and search it in the bank statement credit column. So what you do here? You take this column, all the items that are appearing here, and you go and match it against this. Okay? Similarly, you take all the credit items and you take the debit items here and you go and match it. Okay. So when you match these records, what happens? Sometimes some of the items may not get marked. Some of the items may not get marked. So let's do something like that. Let's say this item gets marked against this. This item marked against this. Similarly, this item marked against this, and that's the only thing. Now you see, after doing all these, you have a balance here, you have a balance here. And you say that these two are not in agreement. That is why you are trying to do a reconciliation. This balance is different to this. But if these two are equal, then there shouldn't be any problem. All these should have been marked. But which is not the case now. You see, here you have one item not marked. Here you have one item which is not marked. Here you have one item which was not marked against you. So we have about 3 items. Here all marked. Here one mark, here this mark. So if you take overall now, the circled items 1, 2, 3. These 3 items are not marked with one each other. We started from here. I took the debits, went and matched against the credits. Then I took the credits, went and matched against the debits. When I did that, this was not marked, this was not marked, this was not. So which means ultimately, why these two balances are not matching? Because of these circled items. Because of these circled items. So the objective of the bank reconciliation, or the first step of the bank reconciliation, is to identify these points. What are the reasons that have caused the mismatch in these two balances? We call it as the mismatch. So it's very clear that there is a mismatch between the two balances, and you have to always remember before you start the bank reconciliation, what is the balance here in your cash book and what is the balance here in the bank statement. Then only you start working on matching. Okay, so I would like you all to take down this. I'll give you about 3-4 minutes. Carefully take down, and if you have any questions, you can send me those questions as a chat where I will answer those. Understand the process very clearly and then take down. So while you are writing, if there are any questions, you may raise those. I'm happy to answer those. So far, I think no questions, right? So you can also ask the question without, no need to type it also. If you want, you can just raise the question. Right. So I hope it is very clear now. What is the process of carrying out the reconciliation? So why do we need to carry out a reconciliation? Because there is a mismatch. If there is no mismatch, then no need for a reconciliation, right? That also you have to remember. If the two balances, when you receive the bank statement at the month end or maybe the first or second day of the next month, First, you will go and check. Yes, I have a debit balance in my cash book, 10,000 rupees. In the bank statement also, 10,000 rupees. It's a credit balance. That's why very important you have to see whether this is a debit here, and if that is a debit, here it should be a credit. Alternatively, you have to remember, if this is a credit in here, then it should be a debit here. Okay? I'll come to that when we look at the questions. Don't get confused at this point in time. So right now assume, generally the cash book balance should have a debit balance because it is an asset to you. So when it is an asset, for the bank, it is a liability. That's why it is a credit. Right? We'll go to another extent when we look at the question. So what do we do here? First we check whether there is a mismatch. Yes, there is a mismatch. Then there is a requirement for a bank reconciliation. Okay, so you determine first whether there is a requirement for a bank reconciliation. If not, we don't do anything because the two records are very clear. Then you determine that there is a requirement for a bank reconciliation. Then the next step, marking of the items. I will take the debit column items and mark it against the credit column items. I will take the credit column items here and mark it against the debit column items. When you do that process, you are sure what is remaining here and what is remaining here which are not marked. And those are the items which is causing this mismatch or difference. Mismatch or difference. Let me go back to the presentation. Right? So the key points are once again is there in your screen. The reconciliation involves two aspects. One is each item in the bank statement needs to be traced to the bank account. Traced means you mark off items. Each item in the bank account of the cash book should be traced to the bank statement. So you do a dual process, marking of items. Then we also need to know the objective of doing this. Now, why are we required to do the bank reconciliation? That we need to understand. Okay? So, the objectives are to ensure the accuracy of balances in the cash book and in the bank account. So, it is very important to note that we are trying to understand that the balance that I am having in my cash book is very correct. How do I ensure it is correct? I will go and check it against the bank statement. And if there is a difference, I will do a reconciliation. So when I do the reconciliation, I'm quite sure that the two records or the two balances are in sync. Then the second point is to identify the omissions and errors in the accounting records of the company or the bank. Now we were talking about some errors. Can you remember? There can be errors accounted by the accountant or the bookkeeper, and also there could have been errors in the bank systems or the bank records. So when you do a reconciliation, these type of things can be identified. I think some of you might have already come across in the bank where customers come and complain, there is one item in the bank statement which does not belong to me. Or sometimes they say the interest that you have credited is wrong or whatever. Or the checkbook cost that you have shown is wrong. I haven't taken any checkbook, so you have debited my account. So likewise, these omissions and errors are also traceable when you do a bank reconciliation. And more importantly, bank reconciliation acts as a mechanism of internal control. So for a company, they need to know what is happening within the company, whether there are any frauds. So if you are to identify those type of things with related to cash, I'm talking about the cash part of it, this bank reconciliation will act as an internal control perspective. So it can be used as a mechanism to have an internal control over your cash book. Then it also has, this is again going as an internal control perspective, to establish any undue delays sorry, in the collection or clearance of checks. Now, sometimes what happens, you have deposited a check, it has not got cleared. So you will come to know when you do the reconciliation. Sometimes what happens, you might also discover transactions that are yet to be recorded in the cash book. As I told you, sometimes there can be direct transactions which has happened in the bank books, but you have not yet recorded. So it is very important that you know what is not yet recorded and what has been recorded. Those are some of the objectives or important. So from the exam perspective, you need to know that these things are tested and have been tested, right? The definition of a bank reconciliation statement, what are the steps involved, why it is important, or the objectives of preparing it, right? All those you have to know. Then we come to the template of the bank reconciliation. So the bank reconciliation statement will look like this. Balance as per bank statement, at deposits yet to clear, checks issued but not yet presented, and you have the bank balance stated in the cash book. Okay, so if you are starting with let me take the board, then it will be easy for you. Right. Now, we are talking about the mismatches. So now the reconciliation template that is given to you is with a starting point of either cash book balance or the bank book balance. You can start from either way. So the reconciliation happens like this. The presentation had the template. I am just putting a rough template. Let's say you are preparing the bank reconciliation statement as at a particular date. So there has to be a starting point. Starting point is, we always start with balance as per, let's say, bank statement. Okay, so you start with the balance as per bank statement. So there is a balance here, the bank statement. Now, we learned about two important reasons. One is checks deposited not yet realized. Second one, checks issued not yet presented. So we learned checks deposited not yet realized. The second one, checks issued not yet presented. Okay, so what do we do here? We do an adjustment for these two items. Okay, then once you do it, what you should get is balance as per cash book. Okay. So you see the objective. I am starting with the balance as per bank statement, which is appearing in the bank statement, and I am trying to end up balance as per cash book, which is known to you. You can look at your cash book and you know the balance. Now, after going through that process of marking of items, you saw, you take the debit column of the cash book, mark against the credit column of the bank statement. You take the credit column of the cash book and mark it against the debit column of the bank statement. Once you do it, one of the fundamental reasons for the difference will be these two. There will be other differences also, which I will tell you how to deal with that. But basic reasons will be these two. So that is why we have put down checks deposit not yet realized, checks issued not yet presented. Now what do we do here? To this balance, either you have to add or deduct this, or you add or deduct this. Then you have to arrive at. Now the question comes, whether I should add this or deduct this. Whether I should add this or deduct this. Okay? So I'll give you the answer. I will add this and I will deduct this. Okay? Can somebody tell me, or whether you can really understand, why I should add the check deposited not yet realized, and deduct the checks issued not yet presented? This is very important. Now, when you go and deposit a check, that is this one, and if it is not yet realized means, what does it mean? Let's say you had a balance of 1,000 rupees in your bank account. 1,000 rupees in your bank account. You go and deposit a check for 5,000 rupees. Now, ideally, what is your balance? It has to be 6,000 rupees. But let's say the check that you deposited is not yet realized. Not yet realized. Then what is your balance? Yes. Okay. Now going back to the example that I taught you all at the beginning of this chapter. When you deposit a check, what have you done? You could have gone and updated your cash book debit column. So whether the check is realized in the bank or not, you have added this 5,000. Is it clear? When I deposit checks into my bank account, what do? I will first go and update my debit column in the cash. Then only I will send the check to the bank. So on a particular date, if this check is not realized, this balance is more, whereas this balance is less. This balance is more than this balance shown in the bank statement. Due to what? Due to the unrealized check. Unrealized check. So if I am to start with the bank statement balance, where I know this has a more balance, this particular check I have to edit. So if you are starting with the bank statement please make it a point. Checks deposited not yet realized have to be added. So you will take all the checks that you have deposited and not yet realized and bring it and add it to this total. When you add it, obviously it comes to this balance, provided there are no other adjustments. But it is not the case. There may be instances where you would have also issued checks but not yet presented. Can you remember the example? A person going out of the country, going abroad without putting the check? So if you recall that example, what would have happened? Let me narrate that example also. Initially, the cash book had a balance of, let's say, 10,000. When you issue a check to a customer, what would you do? Checks issued. I put it in short form, checks issued. When you issue a check, you will go and credit your cash book. You see, when you credit your cash book, the balance will come down. So obviously, now your cash book balance is 7,000. But what has happened? The check that you have given is with the supplier now, and the supplier has gone abroad. He has not put it to the bank. So as long as this has not come to the bank, your bank balance will be more, whereas your cash book balance is less. So from a higher balance, how am I to come to the lower balance? Then I will have to go and deduct all my checks issued which are not yet presented. Not yet presented. So this is what bank reconciliation is. There are other reasons also which I will take separately, but in principle, this is what bank reconciliation is. If you are starting off with the bank statement, remember, checks deposited not yet realized have to be added. Why? It is not considered here, whereas it is considered here. Secondly, the checks issued not yet presented have to be deducted. Why? It is considered here, whereas it is not considered here. Okay? So this balance becomes more because the checks have not yet been presented. Ideally speaking, when it was presented, you have already gone and deducted here. So in order to match these two balances, you have to deduct it. So can you take down this, please? Okay. So going back to the presentation, So you have the bank reconciliation statement, the template, which is same as what I did in the board, but I have added additional part of it just to illustrate what is going to get added and what is going to get deducted. Okay. And as I told you, there are other reasons also which we need to factor into this, which we will learn out of the question that we have. And at the bottom of this slide, you know that there is an important statement made, which says the bank balance included in the statement of financial position. Statement of financial position is the name given for the balance sheet, which we will learn later when we are doing LKS1, which is the accounting standard. So the statement of financial position is the name given for the financial statement of balance sheet. So when you are taking the balance sheet, you need to understand whether I should take my cash book balance or the bank statement balance. Now I have a problem. I have two sets of balances, and you know these two balances are not matching also. So the question here is, which balance should I take for my reporting, financial reporting? And mind you, generally we take the the cash book balance that you have in your cash book. That is the bank column balance in your cash book. So we don't take, for financial reporting purposes, the bank statement balance. The bank statement balance is only a reference to you. It is not the ledger balance for your financial reporting. So financial reporting happens only based on your book balances, not from what you have in the bank statement. Okay, which is very important. And then we have a question. So can we read that question for yourselves? Pereira and Sons has written up its bank account as shown below, reporting a balance at the bank on 3rd April, which is 24,413. The bank statement received on 4th April morning is also shown below. Based on the information provided, prepare a bank reconciliation statement as at 3rd April 2019. Okay. And this is the bank account. Now, when you say bank account, you will not be given as a cash book template. The cash book format will not be given. So this is the bank account. So you will see a debit side and a credit side. You see the debit side and the credit side. What you see on the left side is your debit side. What you see on the right side is your credit side. Okay. Now, when you take this account, what is the bank balance as per your cash book? As per your cash book, you will see at the bottom, you have a balance of 24,413. 24,413. That is the balance of your cash book. Similarly, when you take your bank statement, that also has a balance. You see, this is how a normal bank statement would look like. You have the dates, and you have the debit column, you have the credit column, and there is a balance. Now, according to this bank statement, can somebody tell me what is the bank balance? Is it a debit or a credit? What do you think? It's a credit balance. Very good. Why it is a credit balance? Because you are starting with a credit. 25,000 is your first amount. And then you have continuously, the last column shows you what is your running balance. What is your running balance? So you started with 25,000 and then another 14,000 added, then 2,400 deducted, 1,200 deducted, 10,000 added, 145 deducted, 12,600 deducted. Likewise, when you go on, you have a closing balance of 32,237. 32,237. Whereas in your bank account, you have a balance of 24,413. 24,413. And that is a debit balance. That is a debit balance. So your debits and credits concept is correct. Debit and credit concept is correct. Okay. Now, what is the first step? First step is, I want you all to do, that is, take the debit side of the cash book, and mark it against the credits column of the bank statement. Debit side of the cash book and mark it against the credit column of the bank statement. Quickly. So what are the items that will be marked? Let's say on 1st of April 2019, in the cash book you have 25,000. Now go to the credit column of the bank statement. Yes, it is shown there in the cash bank statement. In the credit column, you have the 25,000 deposits. You see, on 2nd of April, they show this balance. Okay, that is the first item. So 25,000 is marked. Then you will also see 14,192. Take that and go and check it whether that is there in the bank statement. Yes, that is also appearing. 14,192 is also appearing on the credit side. Then take the amount 20,204. 20,204. Go and check whether that is there in the bank statement. And you will observe that that amount is missing. That amount is missing. So you can highlight that. 20,204 is an item which is missing in the bank statement. Okay. Then the next item, they say bank loan 10,000. And when you go to the bank statement, see there also it says on 3rd of April, loan 10,000. Okay. So you have to go by the dates as well as the description that is given there, right? So dates, of course, this date and the bank date might be the same, or there could be a 1 day difference also. But basically, those two are meaning the same item. So 25,000 is available, 14,192 is available, 10,000 is available. What is missing? 20,000 204, 20,204. And when you go to the bank statement, you saw 20,000, 25,000 marked, 14,000 marked, 10,000 marked. So all items have been marked here. Okay. Now let's do the reverse of it. Now take the debit column of the bank statement and mark it against the credit side of the bank account or the cash book. Okay. So first item, 2,400, they say standing order. Do you get that? Yes. It says business rates 2,400. You see? So what has happened here? In order to pay the business rates, the customer has instructed the bank to do a standing order. So they have done that. Then there is 1,200, which says check number 0001. That is the first item. You see? Check number 001 is 1,200. Then the next item, 145. 145 is here. Check number 3 is also marked. Then you have 12,600. 12,600. Do you get that? Yes, it is here. 12,600. Then you also have 600, which is check number 5. Here also it is check number 5, 600. And the last item, 10, you don't see here. You don't see here. So once you have done that, you will observe that the item that is remaining here would be this 10, which is the bank charges. Understandable. As I told you, apart from the deposits not realized and the unpresented checks, there are other items. Now this is one such item, bank charges, which the company doesn't know. Then on this side, 1,200 marked, 38 marked. Sorry, 38 was not marked. Stationery, check number 0002. Okay, 38 is not marked. 2,400 was marked. 145 was marked. 12,600 was marked. 28,000 motor vehicle, check number 004. Check number 004 was missing. So again, that was not marked. Then the last one, cash check 600, which was marked. So ultimately, in the debit side of the bank account, 20,204 was not marked. Here there were two items, the 38 and the 28,000 was not marked. And here it was this 10 rupees, which was not marked. Okay. So if you take as a whole, we have one item here, two items here on the credit side, and one item on the debit side. Now let's understand what these items are. The 20,204, which was appearing on the bank side, debit side, which is known as a deposit, which is not yet realized in the bank account. You see, it has not yet realized because 20,004 is appearing here, whereas it is not appearing in the credit side. So this is going to be your checks deposited, not yet realized. Checks deposited, not yet realized. Then when you take your credit sides, you had this check number 0002 for 38 rupees and motor vehicle check 0004, those were not appearing here. What does it mean? Those two checks which were given to your suppliers or maybe service providers have been not yet presented to the bank, because if it had been presented, it should appear here. You see, check number 1 is appearing, 3 is appearing, 5 is appearing, but 2 and 4 are missing. Missing means those two checks have not yet been presented. Those two checks not yet have been presented. So ultimately, now we have found out what are the checks deposited not yet realized, what are the checks issued not yet presented. And also there is another factor which is going to cause a difference, which is the bank charges on your bank statement. Now, this bank charges is something that the bank has directly charged your account. They have debited your account, but you haven't come across that. That is why you have not recorded it. So when will you record? Once you receive the bank statement in the next month or the period, you will record it. But as of now, you have not recorded it. You understand? So now what are we trying to do is, basically, we are trying to put in numbers into this. So now you know balance as per bank statement, you can have that. Checks deposited not yet realized, you have that. Checks issued not yet presented, you have it. But as I told you, these are not the only differences. There can be other reasons also. And if you go through the statement that you have marked now with the bank statement and the cash book, there was one other item that was remaining, which was the 10 rupees that the bank has charged as the bank charges. Bank charges. So you have put down these items. But in addition to that, there is going to be one more item. Now this will be handled in two ways, but let me put it in this here. We call that as adjustments. Okay, I think in my one of the slides I would have to say adjusting entries. So this is one adjustment, and there you have the bank charges. Can you remember the items that we were talking about? Interest, bank charges, checkbook cost, all those are those items. So now this adjustment also will come here, and finally you will have balance as per cash book. Okay, so this is how it is done now. In addition to the two items that we discussed, there is a third item which is coming in, that is the adjustments. So in the bank statement, you know, this 10 rupees has already got deducted. But in your cash book, it has not come. So now the question is whether I should add this bank charges or deduct this bank charges. Whether I should add these bank charges or deduct these bank charges. So I am leaving that to you because I want you to do this question when we meet next week. Okay, so I have given all the pre-required information and the details, and we have gone through the process of marking of items. So now you know the remaining items. As far as check deposit not realized, you know that the 20,204. And checks issued not yet presented, you know there are two information, that is 38 and 38 rupees and the 28,000. And now you have the bank charges also, which is 10. So I am leaving this puzzle to you, whether the bank charge should be added or deducted. Okay, so that you have to do. So please keep that done. And there is another question also, which is somewhat, I would say, a tricky question, but you can attempt it and see whether you can do it. And let's try to do it at the next class before we start. Okay. And I don't know how many of you have these past papers with you all. If possible, see whether you can purchase at least the latest 4 past papers. Please have them ready, because as we go on parallelly, we will do the past paper questions also. Okay. So probably by next week, I would like to have the bank reconciliation related past paper questions done. So prefer if you can buy the latest four. Latest four in the sense we didn't have the March examination. So which means you have September 19, March 19, September 18 and March 18. At least please buy those four papers. The question paper alone would do. You don't need to buy the answer book or whatever. But sorry, I am getting a message. What is it? It was announced that the IBSL will be giving them free, which will be shared in the classroom. Okay, fine. I'll just check with them. But if possible, if there is any other means of getting it, just see whether you can get it. Preferably, I would like to have those so that we can do the questions also then and there. Okay. So if you have any questions, please make a note of them. We will take up those questions before we start next week, and then we'll get on to these questions. Okay. Thank you very much, and have a pleasant weekend.